Hello and welcome to Money Matters. My name is Dave DeWitt of DeWitt Capital Management. Our co-host today is Michael Brozzetti. He's a certified internal auditor and a certified information systems auditor. So we're going to get into some compliance issues tonight. And after we have our conversation with Mike, we have Michael Malone with Swarthmore Investment who will talk, among other things, about behavioral investing. So, Mike, it's good to see you.
Nice to meet you, Dave.
Yes, good to see you.
Good to see you.
Well, you know, when I saw that we were having a compliance-related person on as our co-host, I immediately thought, wow, we've never had anybody in the compliance world as a co-host. So with all the fraudulent things we hear about on Wall Street and the Madoffs of the world, or Madoff with a lot of money, you know, it's interesting to maybe hear from your perspective how good a job is Wall Street doing in compliance and policing itself.
Yeah, and that's a good question, Dave, that I think you'll hear oftentimes two sides of that argument, where you have advocates that think there needs to be more regulation and more compliance, and an argument where there should be less regulation and less compliance. I think the reality is frauds are getting more sophisticated, and investors are looking for safeguards to protect their investments.
Right.
We saw Sarbanes-Oxley roll around in 2002.
Right.
In response to the more recent financial crisis, we've seen the Dodd-Frank Act getting passed. So I certainly see a pattern of more regulation, and I think the challenge for corporations in responding to that is bolstering and building better compliance systems to keep abreast of what's happening and what they need to do, and hopefully identify issues before they become significant threats to investors.
Yep.
We like to believe boards of directors and CEOs have an interest in understanding and identifying where there might be issues that could affect the investment prior to the regulators identifying it or running into instances where you have a Bernie Madoff type situation.
Yeah, the amazing thing about Bernie Madoff was that how long that continued with people didn't catch it, and the SEC didn't catch it, and almost like you would wonder if he had influence in areas where maybe that was preventing any major SEC investigation earlier on.
Yeah.
A question I have is just of one of the many areas in compliance and governance is insider trading.
Yeah.
How is it possible that the FINRA or the SEC can really keep a lid on that?
Yeah, I think it's certainly a tough thing to monitor, because you're talking about tracking and tracing information, when information is being disclosed, what actions are being taken based upon that information.
Right.
And frankly, it's very difficult. We see in the Dodd-Frank Act now has stricter statutes around statutes of limitations around when security-related violations can actually be prosecuted, as well as whistleblowers being protected.
Right.
So I think a lot of the legal landscape is encouraging whistleblowers that know about this, because I think in a lot of cases you really need to have someone who's intimate with the details.
Right.
And policing it is rather difficult unless you have those, brave souls that are really willing to put their neck out there and raise these issues.
Sure.
And the question is, have the laws historically really protected these people? Again, many would argue that they haven't. So Dodd-Frank is, I think, an attempt to maybe initiate that and provide those protections. But I think any person in a situation where they might want to blow the whistle really has a lot to consider.
Sure.
Because there's no doubt there's a lot at stake. And sometimes I'll kid and say there's two career paths for a whistleblower. It's either going to be getting some type of a large payout or getting on the speaking circuit. Because a lot of times there is a stigma with people that are whistleblowers.
Yeah, I know that we were talking today in a compliance audit about do we have a whistleblower policy?
Okay.
And the fact is we don't even have a whistle.
Yeah.
So we have nobody to blow a whistle.
Right.
The Dodd-Frank bill and that's now law. Maybe you could give us a little update on what that is.
Yeah.
I'm sure a lot of people don't have a clue.
Well, a couple of the primary things that it's done is it's now set up a broader consumer protection agency, which a lot of times when a law is passed, typically some type of authority is given to a regulator. In this case, there's a new regulator that's effectively being created, and they have a responsibility to theoretically now protect consumers.
What's that regulator called?
It is the
new one.
It's a new one. The I want to say Consumer Protection Bureau.
Really?
In the similar thing came out of Sarbanes-Oxley when the law basically established the Public Company Accounting Oversight Board, the PCAOB. So these laws typically create regulatory authorities. These regulatory authorities now have the right and the legal right to promulgate rules and regulations that effectively become law.
Right, and so a lot of investment management companies, banks, brokers, they're all saying, "Oh my goodness me, how many regulatory entities do we have to answer to?"
Yeah.
And now we have another one, and so you could argue that, wow, we're really going overboard on all of this. On the other hand, when I've been in the business since 1983, which dates me pretty clearly, and when you see, for instance, a stock will go in a certain direction, and then finally, it gets to a certain point. Let's say it's going down. And all of a sudden, at the end of a certain period, news comes out. Oh, surprise, surprise! That wasn't publicly known, but accounts for why the stock dropped in half over a long period ahead of time. Now, you could say that could be really good research, or somebody knew something that nobody else knew.
Yeah.
And and that really, really irritates me as an advisor, because there definitely is a lot of that happening.
Yeah.
And I'm relying on you to stop it.
Yeah.
Can you do it?
There's a reasonable level of assurance that can be provided. I think one of the biggest ways to combat these types of activities is for investors to really understand the companies that they're investing in.
Sure.
And the culture of the companies that they're investing in. Looking at their principles around transparency, their mission statement, and some of the things that aren't as hard and fast in a financial statement. I mean, when you're driving your decision making off a spreadsheet, and I think Bernie Madoff's victims followed suit with this. It was, nobody knew about the mission and the principles of Madoff investments. What they knew is a spreadsheet that generated pretty substantial returns.
Sure.
And it's not an exact science. There are certain basic safeguards, I think, from a compliance perspective and a regulatory perspective you can have in place. But when you look at all these big failures, these are things where you had high-level, senior-level people that really were just bad actors.
Yeah.
And how do you find that?
Yeah.
It's hard.
Yeah. We could stay on this topic for a long time, and one of the areas that I'm concerned about is high-speed trading in millisecond, bids and asks disappearing in milliseconds, and market manipulation, all the things that are going in to extract gains out of the market that have nothing to do with investing, that have everything to do with manipulation and moving markets. To me, this borders on the verge of illegal, because it just is against the principles of investing. And it's a lot of people making a lot of money manipulating the market and scaring individual investors away.
Yeah. That's interesting, and I think that's akin to when you look at how many trades are based off of artificial intelligence and computer modeling that factor in a lot of things other than the fundamentals of financial statements.
Sure.
There's a lot of extraneous data that are going into these decision models, and like you say, trades are made in milliseconds.
Yep.
And there's folks out there, if they could make a small gain on reacting in a very short time frame, they're going to do it.
Sure.
And it certainly affects the longer-term investor that's looking for stability and has a longer-term growth strategy.
Right. Well, we're gonna we have a question, and so happens that the question comes from Richard Edwards of Westchester, and his question is, how does compliance services work in the investment industry?
That's a good question, and maybe we could put a little context around this. I mean, I think purely from a service perspective, there are fixed fee models. There are fee models where it's just hourly rates for compliance. The tougher question is, compliance means a lot of things to a lot of different people. Whether you're a registered investment advisor or a broker dealer or a public company, you're all going to have different compliance requirements at a federal law level, at a state law level. And what's important is really, as entities, understand where you need to be compliant. And most organizations are aware of what they have to be compliant with. Where they typically need help is how do we build a compliance process so that we can sort of tame the beast and integrate our compliance into our own business process.
Sure.
And that's key, is you want to make sure that you're meeting the spirit of the laws, but you're also embracing those principles and building it into your business practices so that you can consistently operate that way. And hopefully the law is really a minimum standard for you.
A
lot of organizations espouse to deliver more and be more effective. But that's ultimately, I think, key when it comes to compliance, is understand where are your compliance risks. How do we build a compliance process? And like I said, there's different models, fee for service, there's monthly fees. It really depends on what requirements you're looking to become compliant with. And that's really important to kind of scope the exercise.
So you would work with like a brokerage firm, an investment advisory service, or?
A lot of the work that I do is really with public companies.
Oh, on the public side.
Sarbanes-Oxley
Okay.
is a regulatory law and regulation now that I've really invested a lot of time in. Again, helping companies integrate their compliance requirements into something that's pretty fundamental.
Right.
It's making sure management asserts that they have controls around their financial reporting to investors.
Sure, and meeting the letter of the law is one thing, but the spirit of the law is something that might be very different, because somebody could obey the letter of the law but did misguide people quite significantly.
They could, and part of Sarbanes-Oxley, for example, now puts CEOs and CFOs on the hook.
Sure.
There's level of personal liability if in fact financial statements are materially misstated. So now there's a mechanism to encourage management of organizations to really take this seriously.
Sure.
Because they have a personal skin in the game now.
Right. That's great. That's great to hear. Well, I could talk to you at length about this, but we actually have something really not that yours wasn't interesting, because it was interesting, but we're going to go on the other side of the investment business and talk about one of the things is the behavioral investing. And Mike of Swarthmore Investment, Mike Malone, is our special guest. So it's good to see you, Mike.
Nice to meet you. Thank you.
Mike.
You as well, Mike.
Why don't we start by just telling us a little bit about your company, Swarthmore Investment, and then get into some other questions after that.
Okay, Swarthmore Investment provides two services. We do investment consulting, where we don't handle the management of people's money, but intervene with our perspective on how the world works. And secondly, we manage money. So it's just that simple. We're 100% focused on investments. I think of myself as a whitewater rafting guide. I mean, I'm there to help people deal with the world. If you don't want to get into the markets, don't get in them.
Yeah.
I would think if a lot of people are really not suited to the markets. They think they are.
Yeah.
But once we get in there, I think that you need a professional guide. So, so my business works really, I try to develop what I would call a U portfolio. So it's not like some box. It's understanding a person's circumstances, understanding their risks, their need for income, their perspective, their titling, whatever that is, and then developing a specific strategy for them. So that's what we do. So
you mentioned, but two ways of doing this. One is managing the money, and the other one is you're a consultant.
Yes, I've just created this service really as a result of a friend of mine asking me to do it. And there's a lot of people who have their guy, their friend, their cousin.
Their golfing buddy.
Their golfing buddy, right. They have a lot of these people, and they respect them, and I don't really see a reason why, or they feel comfortable that they don't really want to give their money to anybody.
Right.
They want to keep it themselves, or they might have 401k plans, and they may have money that's kind of locked, but they have a circumstance where they're beginning to realize they don't know what they're doing. I mean, I think it's good for people to come to that understanding.
Yeah.
That they really, they really don't know what they're doing, and they're looking for solid advice.
When somebody comes to the point where they realize they don't know what they're doing, this must be after a period of time when they go into the market and they feel like they can shake it, they can outmaneuver it, they're smarter than the market, and over time realize that the market's a tough place.
Right.
And so you would come in with somebody, and how would you help them?
Well, the unfortunate reality, Dave, and this is what disappoints me, is that when people come to that point, given their behavioral aspect, they tend to believe that the market doesn't work. So they will not come to the point that they don't know what they're doing. They'll say, the market doesn't work, and I'm not going to have anything to do with it.
Right.
And I think people make the stock market too complicated. To me, the market goes up and goes down. That's all I know. It goes up and it goes down.
Yep.
And so it's a place where you can make really decent money. But if we look at the most successful investors who I model my activities after, say Warren Buffett, which is probably the most recognizable person, he simply says, buy when others are fearful and sell when others are greedy.
Sure.
So that's accessible to everybody. Everybody can do that.
Sure.
My question and sort of my mission is, why don't people do that? That's what behavioral finance is all about. It's about why people, they go with their emotions and their feelings. I mean, it's pretty much been proven. Some people may be familiar with a fairly, I would hope it was a fairly successful book, the book Thinking Fast and Slow, which talked about a lot of the behavioral principles. There's a lot of information out there on this, not necessarily related to the stock market. But the reality is that people get a feeling, and then they come up with a rationale. Right. That's how it works. And so, we're constantly coming up with excuses to explain. I mean, when you hear the commentary today, the commentary is, let's come up with a reason why people should continue to be invested in the stock market. Why is that? Well, because we have a basic optimism in our culture.
Sure.
We want to be optimistic. On my website, I say, let's redefine optimism as being able to handle difficult circumstances, not just blindly holding on in the face of kind of reality that says we're not in the right place. So. Sure. So what I do, and I want to say that, I'm thinking of my clients when I sit here. I mean, the last few years, and I would say, have been difficult for me. Because investors looking at this market, the most successful investors I know, all have a tremendous amount of cash. Because because they're looking at the market and saying, we don't see how we can justify putting more money to work. So you might take Robert Rodriguez of FPA Capital, one of the most successful funds in the last 25 years. I think he has 40% in cash.
He's a professional.
And he's a professional.
Sure.
Or Seth Klarman, who is a famous, in our industry, a famous hedge fund manager, has a significant amount of cash. So, so a lot of these successful investors they don't get caught up in the emotion that they feel they have to participate. Most investment managers are concerned about one thing mostly, and that's their career. That's what Jeremy Grantham of GMO talks about. That's the major risk in the investment world, is people taking money away from me. I happen to know that. It happens to me. People fire me in this environment.
Yeah.
Because
now when you go back to like the 2008, 2009 market crash.
Right.
And after that time, I'm sure the compliance business was pretty busy during that period. But there was pervasive negative outlook. And, 3 years ago, 2 years ago, Europe was going to fall off. Italy was going to go down with Portugal. And, Spain was going to go down. And it was all going to be led, and the euro was going to, dissipate and evaporate. And the United States was going to follow. And there was an awful lot of people that I knew personally that swore they will never get involved in the stock market again. One by one, people just came off, and then the market just had 5 years of gains, and so behavioral investing. Maybe go into a little bit about behavioral investing. What were people thinking? What's it take for people to get in? What's going to happen? Are they going to all get in at the wrong time? can maybe that book you maybe there's a book you have that you could tell us about that you read that you thought was good?
Right. I have read extensively, particularly in the last 6 months. I've made it a study to read everything in the behavioral finance that's available. Mm-hmm. And I found the little book of behavioral investing, which is really for the average person.
Is that the name of the book?
The name of the book. There's a series of little books.
Yeah.
The Little Book of Behavioral Investing by James Montier. I also noticed if you're in Delaware County, it's available at the library.
Okay.
So you don't even have to pay for it.
I've seen little books that are littler than the book you're talking about that are little books.
Yeah, right. And so I would recommend two things for the average investor. I mean, really, that's something they can do right now. I mean, I think I had a question about, what do I think of the coming year? Of course, I don't believe in predictions, so I'm not going to give a prediction because, again, those things have no value. They literally, in fact, maybe have a negative value that people would predict because it gets you, and behavioralists talk about it in the book, so I'm not going to, you go and read the book, you'll see how they talk about it. But I think people need to read this book or something like it.
Right.
And then they can identify their biases. And then I think what they should do is they should talk to somebody who understands this concept so that they can apply it to their own circumstances. Yep. And then they'll be on the way to what I see from people is I see this. When you're in 2008-9, what was going on? People were opening their statements. I mean, I remember
they weren't opening their statements.
That's what they came to.
They couldn't stand to look at them.
Exactly. In fact, that you talk about an observation that I make. I make observations of attitudes and actions. How are people thinking? How are they feeling about, and what are they doing?
Sure.
And when people stop looking at their statements, that got me very bullish. I mean, that made me figure we must be very close to the end where they don't even want to hear about it anymore.
Oh, I think it was at least a year and a half. Go ahead.
Do you find when you talk about behavior in investing, do you find people, investors are investing off of emotion?
Almost completely. People go completely on emotion, and again, they also go with the crowd. So maybe I'll give you just one example because I don't want to go too much in depth. Just one example of a study that was done, which was done very early in the 1960s by Stanley Milgram. And it's a famous study because what he did is he had people were told to provide a shock. Now, of course, in the real world, it wasn't happening. But they would say, you're going to provide a shock. 75 volts, the learner will grunt. At 120 volts, the learner will start to verbally complain. At 150s, he demanded to be released. At 285, the learner made a noise that Milgram said could only be described as an agonized scream. Now, this is all an actor performing this, of course.
Right, sure.
But they said that 75% of the people went all the way to the end. When they were told, because they were told by an expert to do it.
Why?
They were told by an expert to do it. Well, sometimes we don't know why. Why people...
The expert told them?
The expert told them to do it.
Why? That this shock is going to be good for you or something?
Yes, the shock's going to be good for you. Another major study that I think made a lot of sense, they even got these sophisticated MBAs, and they would show them a picture of 3 lines, and it was quite clear that one line was really much longer than the others. And then they had the conspirators there who would say, no, these lines are all pretty much the same.
Okay.
And up to 30% of the people would actually go against their visual reality and say, because of the pressure of the crowd. So the pressure of the crowd is unbelievable. And so that's why what Warren Buffett says, because he's a guy people believe, he says success in investing doesn't correlate with IQ. You need a temperament to control the urges that get other people into trouble in investing. And I can tell you that to me that's the hardest thing to do. Mm-hmm. If I have one thing I try to do for investors is I have that intestinal fortitude. People should, if they understood investing principles, which are enduring, they don't change.
Right.
If it's not valued, if it's not a good value, then you're constantly caught up in this emotion. So, for instance, I'm sure, like your expertise in the master limited partnerships, that from 2008 to 9 there was some serious deterioration in price.
There was.
However, why did you hang on? Because you knew you had value.
Oh yeah. Oh yeah.
These were not speculative things that had. So when I look at the current circumstances we're in now, and unfortunately we're not going to show the chart that I have, I think we've been in a speculative kind of market since the late 90s. And we haven't gotten...
Late 90s?
Since the mid-90s. Yeah, so like 95 or 96. Somewhere in that range, we started to move away and become very speculative.
But during the 2000s, the market went nowhere.
Well, that's true during that whole time, but the peak of enthusiasm and excitement was 2000.
It was.
And so we're, what
I can remember that.
The tech bubble.
The tech bubble.
But we have not unraveled that speculation.
I probably believe that too.
We really haven't done it like we did it in the 20s, like we did it.
Well, we don't want to have to go through the 20s.
Well, I know.
We almost did.
Well, one of the things that I find difficult for me to discuss things is when I say what I'm saying, that the markets go up and down, what people hear is I'm negative, that I'm negative on things. I'm not negative. I believe that the markets will reflect this emotional flipping back and forth.
Yeah.
And so my hope for people is that they will break this chain.
Yeah.
And the industry, you're talking about compliance and all, the industry, basically takes advantage of people's emotions, I believe.
Well, you just said in the study, it sort of substantiates that when someone is getting told something by what they perceive as an expert,
right,
they're going to continue to do as the expert instructs them to.
Right.
And I think despite the pain, so I think to an extent, investors, in the past decade have really relied upon some of that advice that maybe they were getting and staying in and continuing to keep their investments maybe in the wrong places.
Well, yeah, I think my observation, it's my personal opinion, if you wanted to judge the quality of your investment advice, I would ask you one simple question. How did you do in 2000 to 2002, and how did you do in 2008 and 2009? How did you do when the markets fell apart? That's when you can tell what kind of advice you have. And in my opinion, that shows that the advice, to say just buy and the market always goes up, we can't tell how valuable that advice is. In my opinion, you have to be able to perform when the markets get into trouble. So my whole focus, even like evaluating what I did last year, I went back to the 3 times when the market went down and said, well, how did I do for my clients when the market went down last year? Not when it went up, because to me, it's going up is silly. If you look at some of the performances last year, forget Netflix, forget Tesla. DuPont was up 45% last year. 3M was up 50% last year. Boeing was up 80% last year. American Express was up 60% last year. That makes me nervous. That tells me these stocks are not supposed to do that well in a single year.
You're right. You're right. And that's a really good point. And we could continue with this conversation for another couple hours, I think, because it's very intriguing. But we have to call a halt, unfortunately. But the name of the book one more time, so people.
The Little Book of Behavioral Investing by James Montier.
Okay.
There are many other things you could read, but I would recommend that because I think it's for the regular person.
Okay, I'm going to have to hold it up there. So we got one book recommendation. Maybe we'll have you back and you can give us another recommendation.
Okay.
That'd be great. So again, thank you for joining Money Matters. Again, my name is Dave DeWitt. Our next guest is going to be John Bogle, founder of the Vanguard Group. So be sure to tune in to Money Matters next time, and thanks for watching.